G'day guys, welcome back. In this video, we are going to talk about another ETF by VanEck. It is called VanEck Factor Morningstar White Moat ETF. He has a ticker code MOAT, and the fund has been around since 2012. The current net asset about 300 million as of July 2021. He has a management cost of 0.49% per year. Thank you so much for Erangaj, I hope I say it right, for recommending to us to look into this ETF. If you look at the price chart of this ETF for the past 5 years, it has done impressive run. It has done 17.4% CAGR. Not only that, this ETF has outperformed S&P 500, who has done 15.3% CAGR for the past 5 years. So here are the discussion points we're going to talk about in this video. First, we're going to talk about what is a moat and what does it mean to have a wide moat. Next, we're going to talk about how does Morningstar assign moat ratings for each company. And then we're going to look into the earnings and the fundamentals of the 48 companies in this ETF as of July 2021. And in the conclusion, we're going to talk about why you should invest in this ETF and why you should not invest in this ETF. Without further ado, let's get into it. So what is an economic moat? The word moat itself by definition means a deep white ditch surrounding a castle, fort, or town, typically filled with water and intended as a defense against an attack. An economic moat means a competitive advantage that defends its long-term profitability for the company. It's a philosophy that is popularized by Warren Buffett. It is also an investment philosophy that led Warren Buffett to invest in Coca-Cola. So here are the list of sources of moat according to Morningstar. You can pause the video and go through each one of them. I'm just gonna read it out so that you're aware of it, such as switching costs, intangible assets, network effect, cost advantage, efficient scale. Based on the previous sources of moat, Morningstar then assign moat ratings for these companies with wide, narrow, and none. Wide ratings means there is a high confidence that excess returns will remain for the next 10 years. Narrow ratings means more likely than not to achieve excess returns for at least the next 10 years. And none means no competitive advantage. Right away when I see this ETF is that I have a concern that they are buying into an overpriced stock. We will go through an example of Microsoft and Coca-Cola where it has done tremendous bull run and then suddenly there is a negative return for a period of about 15 years. But essentially what Morningstar is doing with this ETF is that they're buying companies that they believe has a wide and deep moat and also that they believe is cheap. Now that's the tricky part. How do we know a company is cheap? So really, if you're buying this ETF, you're putting a lot of trust in Morningstar in assigning the price to fair value for each company. If you go through the VanEck website, they have this flyer from Morningstar, which shows you the White Moat Focus Index. And based on 18th of June 2021, they have 48 companies. And they pretty much go through all these white moat companies according to them. And they just put equal weight because if you see the weights, they're all about 2.5 to 2.3%. In saying that they have equal weights, they also have companies such as Adobe and Coca-Cola and McDonald's where they don't put as much weight. They just put less than 2% here. At the least, they put Western Union at 1.22%. And this is where it gets interesting. If you look at the red box here, this is where the price and fair value, the smaller it is, that means it is cheap according to Morningstar. So according to this, Polaris, Merck, Amazon, ServiceNow, Kellogg's is cheap because it has lower than 1 price to fair value. And they definitely will purchase more share on those companies. And later on, we're going to relate with the earnings from 2020 and the market cap. So we can judge briefly whether it's reasonable or not. Next, they also already have added holdings, and they also remove holdings. So there is some degree of activity there. Maybe according to them, Bank of America or Charles Schwab is no longer have a wide moat, or no longer has a prospect to the future. But then, for example, Bank of America, and you still want to hold Bank of America, you question again, why would you sell? Then they also have next potential holdings here, such as Campbell Soup, KLA. Before we get to the fundamentals, I just want to show you a story of negative return when you invest in Microsoft. So in Microsoft, for the past 30 years, from 1991, if you purchase the stock in 1991 and hold it for 2021, that's 30 years. That is amazing. That is a great investment. But then do you have the guts to hold it through a stagnant period from 1999 to 2016, which I believe a lot of people sell out after the dot-com bubble. And that's a period of 17 years. And that is shown in this red box here. So you see a really strong bull run from the 91 till the dot-com era, 99, and then from 99 onwards to 2016, that's about 17 years if you purchase the stock around 99. The reason I'm saying this, because once we look at the PEs of these 48 companies, there are potential overpricing there. And if we look at Microsoft in the late 90s, it has a PE of 60 with a market cap of about $600 billion. This is another example of pricing with Coca-Cola. Warren Buffett purchased Coca-Cola in the late 80s, and from 89 to 98, he has done 7.7x, or about 25% CAGR. That's without accounting the dividends. But from 98 to 2014, for 16 years, it has a negative return, which overall his investment in Coca-Cola from 89 to 2021 has done about 12%. That's without accounting in dividends. So maybe with dividends is about 15% or something. That's still pretty good, but it's not as awesome as 25%. In saying that, here we are. I have compiled the data for market cap based on July 2021. So this is all the market cap followed by the earnings of 2020. Just a reminder that this is just the earnings of 2020. It could be negative just because effect of COVID. That's something to look at further. But I just want to get the earnings out there so that we have an illustration where the PEs are for this ETF. Next, we have the net asset. I look into it because I found something really interesting, that this ETF invests in Philip Morris. And Philip Morris is a tobacco company. And apparently, as of 2021, it has a negative deficit. There's no equity. It's a deficit of $12 billion. So there's quite a lot. And straight away you think, if you are someone who wants to invest ethically and you're anti-tobacco, and also if you're anti a weapon manufacturer such as Lockheed Martin, then this ETF is not for you, because this ETF doesn't really care so much about the ethics. They just want to look at the moat of the company that they believe for the next 10 years will sustain a profitable period. If you look at these three companies here that has a red font, if you look at Guidewire, Cheniere, and Bristol Myers, in 2020 they reported a loss. But that's something you need to look at further. What if they are in the growing stage where they are investing further in themselves and they make great investments? That's something you need to read the annual reports and investigate further. It's interesting too, in the top 10 we have the top names of S&P 500 companies, such as Microsoft, Alphabet, and Amazon, Facebook. So in a way, this is more like a more filtered type ETF compared to S&P 500. And the other thing with the market cap, based on the top 20, the largest market cap is Microsoft, followed by Amazon and Alphabet. And if you look at the top 20 companies, they're all big companies. There's none of them that has market cap smaller than 1 billion. I think the smaller is Compass Mineral International with 2.3 billion US dollars of market cap. If we go back to the price to fair value, where the smaller it is, that means it's cheaper. We see ServiceNow is cheaper according to Morningstar. and it has earning of $120 million in 2020, and it gives a PE ratio of 949. This is why I'm showing you about the PE of Microsoft being 60, and it resulted in a really long negative return. That's my worry with ServiceNow. So if you want to invest in this ETF, you really need to look at the PE ratio that is really high, and that is the case with ServiceNow and Tyler Technologies. See whether they are investing the earnings into more profitable acquisition or projects that will benefit them further and grow revenue, things like that. If you look at price to net asset ratio, you can only see that Berkshire Hathaway has price to net asset of 1. That means they have a lot of tangible asset, which is what Warren Buffett are really famous for. So in 2020 earnings, there are really small PEs there. They such as General Dynamics have a PE of 17, and Berkshire has a PE of 15. And Lockheed Martin, the weapon manufacturer, has a PE of 16. And the rest of the 48 companies, I didn't look it up, but I want to highlight again that they also invest in Altria. Altria is another tobacco giants. And you have to keep asking yourself whether the price to fair value is reasonable and you're happy with it. According to this, Polaris has price to fair value of 0.73. Do you think that's reasonable? A question like that. Now, going back with the market cap, it's a good indication whether your ETF will grow for the next 5 years or not, because the past 5 years it has done awesome. It has done 18.7%. So really you need to look into the companies that is under 100 billions and see whether they will grow really fast. And that's the case with Guidewire, Cheniere. But this Bristol Myers, if you're interested, you can pause the video and look at the earnings. Just a reminder that corporate earnings are dynamic, and price to earning ratio is changed all the time. For example, in 2017, the net profit is 1 billion. And if the market cap is still at 152 billion, that means the PE is 150. That sounds crazy, right? And next we have Guidewire. Guidewire hasn't really produced a lot of net earnings. And if we use the net profit of 2019 of $21 million with the current market cap at $9 billion, it gives a PE ratio of 450. And the sale hasn't really gone up since 2018. So that's something a worry as well. Next, we have Cheniere Energy. It's interesting that it's a LNG company, liquid natural gas. So definitely if you are someone who want to invest ethically, this ETF has tobacco. Now it has a natural gas in it. And if you look at the share price of Cheniere from 2015 to 2021, it has a negative return. And it really shows that it follows a cyclical nature of oil price as well. So that's something to think about as well. So in conclusion, guys, investing in Moat ETF, you're pretty much trusting Morningstar with their rating, price to fair value ratings, to be your value investment advisor. So they're trying to get to the secret recipe of how the success of Warren and Charlie Munger. I found it a bit contradictory because they say, oh, white mode, that means there's a strong confidence, but yet we already spotted 3 companies that has a negative loss in 2020 because nobody knows that the COVID pandemic just happens in 2020 and shook the world. We also found Philip Morris has a negative deficit equity. That's something to worry about as well. If you're looking for a basket of great companies selected by Morningstar, then this is the ETF for you. However, let me remind you, past performance doesn't repeat itself. Narrowing down companies compared to S&P 500 IVV, I think it's riskier. The other thing with white mode is that most likely they have thousands of analysts, the whole world watching, and it can usually result in overpricing when you purchase it. I think to worry as well, when you invest in Moat, there's a potential risk that you are too concentrated in the particular sector. So that's it for today, guys. Thank you so much for watching, and I'll see you in the next video.